If you are an investor who bought into the hype of 17 Live back in 2023, you probably saw the headline. And more importantly, you felt the pain in your portfolio. We are talking about a catastrophic 70% drop from the listing price. If you put $10,000 into that stock, hoping for a tech revolution, you are left with barely $3,000 today. It is the kind of destruction that makes people swear off the SGX entirely and keep their money in a biscuit tin. When you see numbers like that, a 70% collapse or SAM Holdings wiping out 72% of its value, it is easy to look at the Singapore market and say it is broken. It is easy to say that new listings are just traps designed to separate retail investors from their hard-earned savings. But if you strip away the one-offs, and if you look past the disasters that made the front pages, the real decline in the broader market narrative is actually misleading. While the story stocks were burning to the ground, a quiet revolution was happening right underneath our noses in 2025. If you have been sitting on the sidelines in cash because you were scared by the 17 Live disaster, you missed a massive pivot. The market didn't stop rewarding investors, it just completely changed the rules of the game. We have moved from an era of selling hope to an era of selling yield. The real story isn't that the SGX is dead, it's that the mental model for making money in Singapore has shifted from speculation to tangible assets. I am Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the sensationalist headlines, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work to make sure you have the right data. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide by slide, through the SGX IPO scorecard to understand why 2025 feels like spring after a brutal winter and how we evaluate the upcoming listing of Ultra Green. AI, let's start our methodical breakdown by looking at what I call phase 1, the graveyard. This covers the brutal winter of 2023 and 2024. To understand where we are going, we have to understand the wreckage we just left behind. The defining characteristic of this cohort was that they were selling narratives. They were selling PowerPoint decks. They were selling themes, tech, medical, green energy. But when you open the hood, there was very little horsepower in terms of cash flow. Let's analyze the most prominent casualty. 17 Live. It listed at $3.88. As of late November 2025, it is trading at $1.14. That is a negative 70% return. Why did this happen? It wasn't just bad luck, it was structural. First, we need to talk about the SPAC structure. For those who are new to this term, a SPAC is a special purpose acquisition company. It is essentially a blank check company that lists with no operations solely to buy another company later. This structure screams financial engineering. In the Singapore context, investors hate complexity. We have what I call the complexity discount. If you have to read the prospectus 3 times to figure out how the company actually makes a dollar, the market will punish it. Furthermore, let's look at the business model itself. 17 Live relies on tipping revenue. This is discretionary spending. When inflation hits and the economy tightens, people stop tipping streamers. Compare that to a contract-based business. Tipping is volatile, contracts are fixed. 17. Live had no revenue floor. The lesson here for us is clear. In Singapore, complexity combined with volatile discretionary earnings is a recipe for a portfolio disaster. Then we have SAM Holdings, down 72%. This falls into the medical hope category. They were selling a vision of future medical breakthroughs, but they had no revenue floor to support the stock price while they waited for that future to arrive. When the hype faded, there was no yield and no cash flow to catch the falling knife. However, there was an outlier in this winter phase that we need to pay attention to. Winking Studios. While the giants were collapsing, this small cap stock is actually up 22.5%. Why? This is crucial for your learning curve. Winking Studios is a B2B service provider. They don't rely on hope or consumer tipping. They rely on contracts with massive global giants like Ubisoft and Tencent. They are what we call a pick and shovel play. They are selling the tools, in this case, digital art and outsourcing, to the people mining for gold. This is a business model that the SGX understands. It is tangible, it is contractual, it is visible. Now, let's shift gears to phase 2, the revival. This is the 2025 spring we are currently experiencing. The 2025 cohort of listings is fundamentally different. These companies are not trying to change the world. They are not promising to cure cancer or invent the next AI. They are simply trying to pay rent. And interestingly enough, the market has rewarded them for it. Let's look at the star performer, Centurion Accommodation REIT. It listed at 88 cents and is now trading at $1.17. That is a 33% gain. In a market where people are terrified of losses, a 33% gain is massive. So let's define why this works. We need to talk about the inflation pass-through mechanism. This is a concept you must understand for your portfolio. When inflation goes up, construction costs rise. When construction costs rise, it becomes too expensive to build new dormitories. This restricts supply. When supply stays low but demand for foreign worker housing remains high, what happens? Centurion raises the rent. This is the alpha, this is the edge. We aren't buying Centurion because we have a sentimental attachment to dormitories. We are buying it because it is one of the few assets on the SGX that actually benefits from the supply chain inflation that is hurting almost every other sector. It turns a headwind into a tailwind. This is what we call a defensive mode. Next, let's look at NTT Global Data Centers REIT. It listed at $1 and is trading at 99 cents. Now, you might look at that and say, Iggy is down 1%. That's a failure. And this is where I need to correct your perspective. In a year where growth stocks have been whipped around by interest rate fears and volatility, a stock that stays flat is a victory. This is what I call the boring premium. Why is flat the new up? Because while the price is flat, it is paying you a 6 to 7% yield. It is a sanctuary. It offers stability. When we analyze REITs, we look at WALE, weighted average lease expiry. Data centers generally have long leases with high-quality tenants. That is stability. In a volatile world, capital preservation plus yield is a winning strategy. So we have established the trend. The market hates complexity and hope. The market loves simplicity, tangible assets, and yield. This brings us to the present day and the upcoming test. Ultra Green AI. The marketing machine is already spinning up. You're going to see ads. You're going to see headlines calling this the next big tech play for Singapore. But we are not going to get sucked in by the marketing. We are going to apply our Iggy's pre-IPO filter based on the lessons from 2023 to 2025. When you look at the prospectus for Ultra Green, I want you to ignore the pictures of the green technology and the buzzwords about saving the planet. I want you to look for one specific ratio. The pilot versus production ratio. This is the metric that determines if this stock is a trap or a gem. Let me define this. A pilot program is a trial. It is a company saying, hey, we will try your software for 3 months. It can be cancelled tomorrow. It generates revenue, yes, but it is low quality, unsecured revenue. If their prospectus shows that 80 or 90% of their revenue comes from 50 different pilot programs, this is a story stock. It is 17 live all over again. It is a trap. The revenue looks good on a chart, but the foundation is sand. On the other hand, the production revenue comes from long-term integration. This is a 5-year locked-in licensing contract with penalties for cancellation. This is a company saying, we cannot run our business without your software. If Ultra Green AI shows us that their revenue is anchored by these long-term contracts, then it is an asset stock. It moves from being a speculative tech play to a cash flow play. Remember, tech is not the enemy. Unsecured revenue is the enemy. Now let's move to Iggy's assessment and bring this all together into a conclusion for your portfolio. What is working right now? The boring trade is working. Balance sheets that are fortresses are working. Companies like Centurion that own real assets, beds, buildings, infrastructure are the ones delivering returns. The market is paying a premium for visibility. If you can see the cash flow 3 years out, the stock holds up. Japan and specialized real estate are proving to be the new growth engines because they offer yield with a growth kicker. What is not working? Hope is not working. Complexity is not working. Any company that requires you to believe in a change in consumer behavior, like tipping on an app, is getting crushed. The North American occupancy issues in some REITs are still a drag, and future hedge costs are a headwind we need to watch. But broadly speaking, the risk is concentrated in unproven business models. So, how do we look at valuations? Currently, the asset stocks are trading at fair valuations. They aren't cheap anymore because the market has woken up to their value, but they aren't in bubble territory. Yields in the 5 to 7% range for these stable assets are attractive compared to fixed deposits, especially as we anticipate interest rates eventually stabilizing or coming down. Here is my final recommendation, split for those of you already in the market and those looking to enter. For existing unit holders of the spring cohort, stocks like Centurion or the data center REITs, my view is to hold. The yield is decent and the fundamental thesis of supply constraints remains intact. You are being paid to wait. These are the defensive pillars of your portfolio. Do not sell these to chase the next shiny object. For new buyers looking at upcoming IPOs like Ultra Green, AI or others in the pipeline, wait, the risk reward isn't there yet until we see the prospectus. Do not buy on day one just because of the hype. I would wait for the price to settle. And more importantly, wait for that first quarterly earnings report to confirm the pilot versus production mix. If the market prices it as a high growth tech stock, it is likely overvalued. I would wait for a price entry that reflects it as a cash flow business, not a dream factory. Investing in Singapore doesn't have to be a gamble. It requires discipline to ignore the flashy headlines and focus on the boring mechanics of how a company actually gets paid. If you found this valuable and want to go even deeper into these prospectuses, consider becoming a free or paid subscriber to our Substack newsletter. We break down these numbers line by line so you don't have to. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We are also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Your support allows us to stay independent and keep cutting through the noise. Thanks for watching, keep your portfolio boring, and I'll see you in the next analysis.